BTI continues to be significantly undervalued by the market with a yield of nearly 9% and some fresh news that New Zealand's smoke generational ban has had a U-turn. We're going to touch upon all of this in today's episode. We're also going to run BTI through our stock valuation model based on their updated earnings report, looking at our revised intrinsic value and our acceptable buy price. We're also going to take a look at the important dividend safety and touch upon how safe this dividend is, as well as some incredibly important financial metrics you need to understand for British American tobacco. As always, we will quickly touch upon what the institutions are doing, whether they're buying or selling this company, as well as taking a look at the total return performance of BTI versus some well-known competitors in the industry, such as Altria Group and Philip Morris. And we also want to see how their balance sheet is based on their latest earnings, whether or not they continue to have a safe balance sheet with their total cash and total debt positions. And we'll also take a look at their top line and bottom line income increase year on year and have a very quick look at their trailing 12-month figures. Now, BTI has been hammered this year. It is down 20% year to date, significantly worse, in fact, than Altria Group, which we've also analysed today, and underperforming the S&P 500. It is as there towards the 52-week low, and we can see that very nice yield of 8.8%. Now, investors who have been holding the company over the last 10 years would in fact be down around 39%, bearing in mind this doesn't include those dividends reinvested. And we do see the share price peaking over the last 10 years in mid-2017 around $73. So can we see BTI's share price increase by more than double the all-time high that we saw over that period, as well as seeing our yield on cost grow in double digits? Well, let's take a look on today's episode, and let's start off with the income statement. Now, top line, we like to see as always 3 to 7% growth year on year. 31 billion in December 2018, 33.5 billion in 2022. So it has increased by around 10% over the last 5 years. But interestingly, when we do look on a more granular level, we do see a larger increase to 2019 and then an increase to 2020 before dropping down in 21 and 22. But do note, we do see a fairly nice trading 12 months figure of 35.8 billion. So it does look like 2023's annual report will show some signs of a nice increase. Now, when we compare that to the bottom line net income, what story does that tell us? Well, 7.7 billion reported in December 2018, 8.1 billion in 2022. So yes, the bottom line has increased, but again, on a more granular level, we do see the inconsistencies we saw on the top line. A decrease to 2019, an increase to 2020, another increase followed by a sharp decrease. But again, do note we are expecting, based on the trading 12 months, a very strong and 5-year high bottom line net income. So there are some positives now to think about, as BTI is at a very undervalued price that we will touch upon shortly. Now, a quick health check based on their latest report on their total cash and total debt. Well, they held to December 2018 3.5 billion on the balance sheet, short-term investments included. And in their latest quarterly report, this has increased to 5.2 billion. So they are holding more cash than they did 5 years ago. And when we compare that to their total debt, what we can in actual fact see is it has decreased from 60.5 billion to 53.5 billion, which in my opinion is positive. Their cash has increased while their total debt has decreased. So good news, and we will take a look at the net debt to EBITDA shortly too, which will impact that dividend safety. Now, comparing them to other companies in the tobacco industry on a year-to-date basis, we can see BTI, remember this includes those dividends reinvested, down 14.73%, the worst performing in the tobacco industry. Now, we do see one of their fierce competitors, Altria Group, down at a slightly lower at 2.88. Now, when we increase this to 5 years, as always, more information available. It's just better to get that data when you do analyze. On the 5-year, BTI are up 35%, and they are the second best performing in the industry behind Philip Morris, which is up 49%. Now, that is fairly positive, but again, do remember that past performance is never indicative of the future, and it really does depend as an investor what you are looking for, whether it is a growth play or you're just looking for those dividends year on year. Now, institutions, what are they doing? Well, around 7.5% institutional ownership. 1.43 billion worth of shares sold by the institutions over the last 12 months, roughly the same bought in that same period. So we can see there is no real sign as to whether the institutions are preferring to buy or sell the stock. In Q3, we do see a slight or a marginal increase in shares bought versus sold, with a roughly similar in Q2 and slightly more selling in Q1 than buying. But as always, do not copy what institutions do, play for play. Do also do your own due diligence. But again, it is something you can look at when researching your companies. Now, I did touch upon this when I did review the Altria Group, so if you have seen that video, you can skip past this segment, but if you haven't, then we can run through this article, and it basically talks about New Zealand's smoking ban, U-turn, and why this is bad for Rishi Sunak, who is the UK Prime Minister at this time, who has effectively declared that he is looking to do similar to what New Zealand did before they ended up banning it. So very quickly, effectively, New Zealand's new coalition government, what they've announced was that they're scrapping the plans to put in place a generational smoking ban. What this effectively would have done would have steadily lifted the legal age for buying cigarettes from 2027 and therefore stopping anyone born after 2008 from purchasing them. Now, one of the reasons why this is effectively is slightly strange, and we'll just discuss that now, but also we do see they aren't willing to give this experiment a chance, is that they would have a few different policies, especially burdens on the businesses, one day having to ID people in their 50s and 60s, as if you were born over 2009, for example. If you were in 2009, you wouldn't be able to buy cigarettes, but if you weren't born in 2007, you would, and therefore, if you and your friend, argument's sake, in your 50s, one was slightly older than the other, one of you would be able to buy and the other one wouldn't. Essentially creating a two-tier society of adults where some have more rights than others. So slightly weird. Nonetheless, it is something that they have scrapped, and it will be interesting to see what the UK do based on this. And one fact that was quite interesting from this article, now this does relate to the UK, but essentially says that kids are increasingly rejecting cigarettes. So the percentage of children who do try smoking has plummeted from over 50% in the early 1980s to around 12% in the 2020s. So again, a few factors just to consider as a long-term investor, or whether you're just a short-term investor regardless, in the tobacco industry. Now, jumping on to the dividend safety, which is very important for a company like BTI, likewise Altria Group. We see a score of 45, borderline safe, which we'll touch upon. Market cap 71.8 billion, making a large cap company. Now, in terms of recessionary metrics, well, they increased the dividend during the 07-09 recession, plus 4.8 sales, so this was above the average growth of companies in the S&P 500, which was negative, and it did also beat the S&P, down 31% versus negative 55. Now, 1% increase for the last full year, not great. Yes, you are getting a high yield, but you're not even keeping up in line with inflation, so it is biting into that yield. Last 5 years, not bad. Again, 4% yield, so you're keeping up with inflation whilst raking in an 8.8% yield. So you could argue that's decent. And last 20 years, 10%, very nice to see. And it would be good to see some high, mid, or single-digit increases. Now, they are 2 years away from being a dividend aristocrat, paying increasing dividends for 25 years or more. And if we look at dividend yield theory, well, we have our sign of undervaluation, with the current yield sitting above the 5-year average, as well as the forward PE sitting far below the 5-year average of 8.6. Now, when we do compare the sector PE, we do see the consumer staples significantly higher at 18.7. And as I mentioned at the beginning of the episode, yes, it is towards the 52-week low, but do bear in mind, 52-week low is never a signal for undervaluation. Likewise, 52-week high is never a signal for overvaluation. Free cash flow, please. This is what I personally draw your attention to. The reason why earnings is susceptible to manipulation by management through accounting. And for tobacco companies, we do look for below 85%. Very nice to see, with BTI significantly under that over the last 5 years, with 2023 expected to be in the low 50s as well. So that is positive. So far, that dividend does seem to be safe in my opinion. Again, free cash flow 195 to 432 in 2022. Nice growth over the last 10 years. Yes, it isn't consistent increases year on year, but it is moving in the right direction, which is always positive to see as an investor. Now, one thing to note about the tobacco industry, you would expect to see the top line decreasing year on year. With BTI, however, we do see some mixed essential numbers. We see some double-digit negative growth, and then we see some double-digit increases, with some years relatively flat. So it is fairly inconsistent. And if you want to look at that numerically, well, 15 billion worth of sales in 2013, 28 billion in 2022. So yes, it is increasing, but you are getting some peaks and troughs year on year with this company. Now, shares outstanding, interestingly, opposite to what we saw with Altria, where they paid back around 10 billion or in fact, sorry, 10% of their shares over the last 10 years. With BTI, they are diluting your position as a shareholder, with the shares increasing year on year. So just factor that in to your investment decisions. And we can see the ROIC, whilst I like to see 10% or more year on year, the reason for this, because it gives me faith that management are able to effectively allocate their capital. We can see for the last 6 years, it has been below that for BTI, but we can see the trailing 12 months around 10%. So if it does start to creep back up again to what we saw from 2013 to 2016, that is a very positive signal for me. Now, operating margin, free cash flow margin, very, very strong and consistent on both of them, which is positive to see for a company like BTI. And one of the most important metrics, in my opinion, especially for that dividend safety, which is a big draw for investors, is the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. What we're looking for is less than 3, signaling the number of years it would take the company to pay off all of their debt net of cash on hand. And we can see the last few years it has straddled around that 3, and it is expected to come down even lower in 2023. So personally, I do believe their dividend to be safe unless something fundamentally changes. Now we can jump into the stock valuation model. And as always, if you do enjoy the content, value is being provided. Do smash the like button, do hit the subscribe and bell so you are continually notified of these videos as they drop. And if you do want to grab a copy of the intrinsic value calculator to get to your acceptable buy price of companies in your own portfolio, then do click on that pinned comment. Now, starting off with Graham's valuation for BTI, we have the earnings per share, growth rate per analyst estimates, current yield on AAA corporate bonds, and intrinsic value. Remember, the higher the yield, the lower the intrinsic value. It comes to $74. Now, this is significantly higher than the current trading price, and we can see it's even higher than the highs that we saw in 2017. So again, there seems to be some significant undervaluation based on Graham's valuation model. We then move on to the second model, the multiples valuation, companies in a similar sector and size, Altria, Philip Morris, Universal. We have their stock price, earnings per share, PE, average P multiplied by the earnings per share to give a stock price of $62. Again, significant undervaluation, nearly 100% upside. And remember, you are locking in a very high yield, so you'd expect your yield on cost to grow year on year. Now, remember, we're not looking at any of these models in isolation, and we'll draw our conclusions towards the end. We then have the DDM model, the dividend discount model, where we have the yearly dividends. Average growth around 2.2%. Now, this is slightly off. This isn't a dividend cut, just that these dividends are paid out in pound sterling. So depending on the FX rate, these will differ. But on average, they do increase by 4% year on year over the last 5 years. So I have gone slightly more pessimistic at 2.5%. But as always, when you grab a copy of the model, you can play around with the numbers based on your essential investment thesis. So this gives a DDM price of $50. So again, strong upside to the current trading price above the 52-week high, showing signs again of undervaluation. We then move on to the DCF model, where we have the free cash flow year on year, average growth rate at 12.4%. Now, growth rate is expected negative 3% per analyst estimates, and we do factor that in with our discount rate to get the present value of future free cash flows and terminal value. Once we add together with the cash, subtract total debt, arrive at the equity value, divide by shares outstanding, we get a DCF price of $50. Now, the intrinsic value, remember, is just the average of these models, and we can see every single model showing a significant undervaluation. So the intrinsic value here comes to $59. And don't forget, if you do enjoy the content, value is being provided, do smash that like button, hit the subscribe and bell so you are continually notified of these golden videos as they drop. Now, margin of safety, as always, we always start with 10%, but remember, that's what we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. And it is a buy up to $53. Now, if we bump that up to 30%, it's still a buy up to $41. And at 40%, it's still showing a buy. If we move to 45, it's roughly there at the current price. So right now, you are locking in, based on our estimates and judgments, a 45% margin of safety. Bearing in mind, though, that margin of safety level will depend on your own risk level and factors such as the macroeconomic conditions, the tobacco industry as a whole, and really where you see this industry moving, whether or not these companies will still be here in 10 to 20 or 30 years. Now, Wall Street, what do they say? Well, they believe the share price over the next 12 months to go up to around $43, not as high as our intrinsic value, but they do see some significant undervaluation in the market. As always, though, do let me know your thoughts in the comments below, whether or not you believe that BTI is incredibly undervalued, or you believe it's trading at a fair price, and whether or not you hold this or Altria Group, and your pros and cons to either. Don't forget, if you do want to grab a copy of the valuation model, to click on that pinned comment and pick up a copy so you can run through your own companies to get your own acceptable buy price, or if you just want to run through BTI again based on your own estimates and judgments. As always, do like if you enjoyed today's episode, do subscribe and hit the bell to be continually updated with these videos, and drop your comments and just have a great day. Catch you on the next episode and take care.